Welcome to Odds and Ends podcast. This is Dave and Rob getting ready for our second week of January, our first real full week. Good evening, Rob.
Yeah, it is a full week. But it's sandwiched in between a shortened week and then another shortened week, because we have next Friday is the Friday, or this coming Friday is the Friday before another long weekend, Martin Luther King Jr. Day. And it's falling. It just seems like it's coming early in the month, because a lot of times it's around the 19th or 20th. But here it is on the 15th, right?
Mm-hmm.
So, no, actually, sorry. I mean, well, it is on the 15th, but we've got the long weekend here already coming to us on the 13th, 14th. So this is going to be weird because it's sandwiched in between. So it is a full week, and this is when institutions get a little bit more active. Volumes should rise a little bit. The first week of January is also, always one of those things that, people take it easy to get back into stride and see what the market's doing. We didn't have a very good, finish to the Santa Claus rally, which is supposed to be the first 2 days of the month. And they always talk about, the first 5 days of January, the way that goes, so goes the year, or as January goes, so goes the year. There's a lot of stresses on January, but we've seen quite a bit of rotation. So we'll talk about that a little bit more as we get into this here. So first, the spider, we can see that it pulled back here this week. So we had these 4 days here, and just pulled back and didn't really give us too much love in terms of bullishness. I'm thankful that we're always trading hedged, and it doesn't really matter so much what the market's actually doing, but if we can use it to our advantage, we will. So it's given us a drop just below the simple moving average there, the 20-day. Still quite a bit above the 50 and the 200, of course. Here's the Qs, a little bit further discounted, and that was just because, the technology stocks and the bigger discretionary stocks within the Qs have been softer recently. And then we had the Dow holding up better. It's had a very, very smooth run since the end of October, beginning of November. And it just, you can see the fact that it was lagging most of the year up till that point, and it just seemed like people wanted to start positioning some into the Dow 30, and this is a price weighted index rather than market cap weighted, so it doesn't have the same sort of problem with only a few stocks moving it around, which creates a lot more volatility. So it's been pretty smooth, and it's been really stable lately. So we've seen this rotation into some of the blue chips, the dividend payers, the more value stocks, the industrials, financials, healthcare. So we've seen a lot more focus there. And then the Russell was doing, reasonably well, like the Dow was, and then it just, really pulled back hard here. And that tends to happen if, the leadership's not there with the big names in the NASDAQ and so on. Some of the upcomer growth stocks, they tend to fail as well. So we've actually filled this gap that we had back here off of the December 13th FOMC meeting into the 14th. We've come back and filled that gap. So now that's filled. We, kind of halfway between the Bollinger Bands here and just below, again, the 20-day moving average. So a turn is possible. So we'll have to keep that in perspective. Looking at the sector performances for Friday and for the week, this was Friday. Financials were on top. I mean, not huge performance, but they were all pretty much green. All the money-centered banks were green. Utilities, they've been the lagger last year. Again, they've been, popping up every once in a while a little bit better. Energy is also very interesting with all the increase of bottlenecks in shipping with the Red Sea, as well as the Panama Canal has got problems with the drought. So there's a little bit of hampering of the movement of ships, and that does play into energy somewhat. There's also the Middle East expansion of regions that seems to be affected more and more, and don't expect that to slow down anytime soon. So energy is an interesting one. It always has sort of these good days and bad days. The volatility is very high, so keep that in mind. Consumer cyclical, it's got Tesla and Amazon in there as the bigger names. So whatever they're doing seems to impact it the most. But defensive was, it was acting, and it should have been a risk on day, but it was really kind of a checkerboard experience on Friday. We'll look at that map of the market here shortly, but it was just a weird day, and defensive was in the bottom of the pile here. The 1 week performance, healthcare carrying over from the week before as well, where we've seen mergers in December and just a lot of bullishness. Pfizer and stuff like that kind of coming back off the bottom and performing pretty well. So healthcare had a good week. Utilities as well, energy as well, and then technology for the week was actually at the bottom here. So Apple had weakness, Nvidia had a good Friday, but other than that, for the week it was a bit softer, and so we just we lost 4.78% in technology for the week, so it was really rough. Cyclical as well. Real estate, well, they had a good December with all the expectations of interest rate cuts, but this week some of that faded a little bit, and we had the minutes come out and so on. So it was just a little bit rougher on the real estate area. And with the dollar, it went up slightly, so it impacted basic materials. And of course, dollar and treasuries are all connected. And so these two groups, basic materials and real estate, constantly get impacted by that. Looking at the market and sector ETFs performance, I want to point out over here on the relative volume, it wasn't a bad week for volume. There was still some under one relative volume, but we saw some over one as well. And that was much better than the week before between Christmas and New Year's. So, and then this coming week here, we expect volumes to start to rise. So we should see a lot more over one and not so many under one. Over here in again, IWM getting whacked the most, XLK next, and XLY next. On the outstanding, obviously, healthcare, XLV, XLU, and XLP still did okay for the week, even though Friday it was the defensive names were down. So there you have that. Here's the map of the market for Friday, which we said was a checkerboard. It looks like that. Financials, at least the banks part of it, not the financial data side, but banks, capital markets, and regionals all doing well. There's your standout, Nvidia here in the semiconductors. Meta had a good day. Amazon, Tesla, not contributing much, and then the restaurants were hurting. Maybe nobody has any money to spend after Christmas anymore in the restaurant area. So that's kind of interesting. I think, historically I see this kind of hit the restaurants in certainly January up to maybe Valentine's Day, then they pick up a little bit. And then it takes going into the spring to have them, bounce back harder. But common thing in early January. Consumer defensive, we see some of the weakness here, and then healthcare, of course, the strength. So let's move on to the week. There's what happened for the week. Now you can see why technology suffered so much, even though Nvidia you know, it was down more so earlier, and then Friday pulled it through, so it only was down 0.86% for the week. Avco having a bad one. I mean, it's just like a lot of 4, 5, 6% down. Amazon, Tesla as well.
Apple was a big drag on the market though the entire week.
It was. It really, really was. And I often look for that and say, if they're shorting that, what else are they buying? It wouldn't have helped you too much this week because like so much other things that you could have bought by shorting Apple were also down. But look at the contrast here with the healthcare, and that's what we're trying to communicate is that investors don't want to leave the market entirely. They want to take profit in the names that were up so much last year. I mean, you have a lot of these stocks that were up over 50%, 100%, some of them, 200% for NVIDIA for sure. But they want to take profit in these names because they didn't close it last year because then they would have had to pay tax on it. You go into this year, now you sell it, lock in the profit, pay tax, next year on the stuff this year that you sold, but you don't want to leave the market. So where else can you position it? Well, some of the laggers, utilities, obviously laggers, energy might bounce back, maybe some there. Banks, always a safer spot, I think, to money center banks anyway to put it in, especially when treasuries and so on are stabilizing, and we've come out of that, massive rise in interest rates so quickly, and there's been some time now to get stabilized. So people putting money in there. Insurance, obviously, some good opportunities in insurance, and then defensive. I think overall, will still be a place that people can put some money if they don't want to redeploy in all the growth names and the high PEs and stuff like that. There's some real treasures in terms of price to earnings ratios and price to book ratios in some of these other more forgotten and overlooked sectors. But as I said, if they're selling these names, they want to stay in the market. They've got to redeploy it, and that's what you're seeing here in at least this first week of the year, which was a shortened week. Now, with the sell-off in those names and the market, we looked at the SPY, we looked at the Qs, how it pulled back this week. The thing that people would think is, well, we've had a huge spike in volatility. And the answer is no. We have been stable in this 13 to 15 and a half, 16. We've been stable right in there, currently at 15.55 on the VXX. And so there's not the concern about the market selling off completely. So that's, again, why I'm focusing you on the rotation aspect, not the exit out of the market, not the doom and gloom type of thing. Obviously, I think there's concerns, but there's an unwillingness to exit the market completely. Volatility is low. They're not protecting other people's money at this point in time. If something comes up, that might change. But again, people that often sit on the VXX expecting there to be the end of the world, they're disappointed as it decays on them during their holding time, and they lose money waiting for the end of the world event. Okay. So seasonality, let's just a reminder here. We looked at this last week. So the first trading day of the month was down, expected to be down, and we did see it softer. The first Friday was supposed to be up, and we did not see that to the degree that we would have liked to. It wasn't a bad day, and like we went through the map of the market and the sectors, and it did close just up just slightly, but not as robust as what it shows here. Now, mid-month seasonality starts on this coming Friday, and the problem with that is it's split between a long weekend. So do Fridays in front of a long weekend rally generally? There has been that historically. There's been, a happiness, an expectation. Hey, we get a long weekend. So I would say it's possible for it to be up. And Fridays in general in January have been okay. So, I would say that if the market was to rally a lot before Friday, then I would temper that down a bit. But if the market was quite discounted the first 4 days of the week, I would lean into Friday a little bit more for potential bullishness. But there's still, again, the geopolitical risk. A long weekend, things can happen, so there's still risk of exposure. So we could have a rally on the Friday, but we might have hot money come back out of it before the end of the day. That's always possible. Um, but anyway, it's the third Friday of the month, which will be the 19th. That is more of a bullish candidate. Okay, so that's expiration Friday. So we'll talk about more of that seasonality mid-month as well as that expiration Friday. We'll talk about that next week when we do our podcast. And this is the calendar. Well, just before we get to the calendar, well, actually, I'll wait. Why don't you go through that, and then we'll look at what the futures are doing tonight. Okay?
Yeah. In terms of the economic reports, the theme is going to be inflation, but Monday we have consumer credit to see how indebted the country is. Tuesday, some trade deficit data, and Wednesday, some wholesale inventories and a little bit of Fed speak. But the main thing is Thursday, there's a CPI report, and then Friday, the PPI report. CPI, again, it measures the price to the end user. PPI is the price that producers pay at the wholesale level. So both of those are important, and I think that's going to be the main thing to lean
Well,
on.
I mean, what a litmus test, right? When it's year over year as well. So it's not just the December. We get the year over year, so you can see how have we really been doing this past year. So this is a great litmus test here.
Good. And then in terms of earnings, there's just a couple. There's on Wednesday, KB Homes, and then on Friday, Delta Airlines and Wells Fargo. So not very heavy in the earnings side, but the inflation data hopefully will give us some direction.
Okay, good. Well, let's see what we got here for the US dollar here. So right, we had a big range day on Friday. Was the economic reports really stressed people out on Friday, and I think that's kind of why it was kind of tough sledding. So we had volatility in the dollar. Like, we can look at that here. We'll roll it back. You can see that we spiked up and we also went down and then retraced. We had a crazy day, a big range day in the dollar, and that threw everything into an upset. And the same thing happened in the bonds. Like I said, they're connected here. If yields rise, the dollar should be stronger. So you can see the inverse move. Treasuries yields moving down, then back up. You see this? So between the dollar in affecting basic materials, affecting energy, affecting gold, things like that, and then the treasuries affecting the REITs, right? I mean, we had like a crazy day. It really, really was. Did you feel it, Dave? Was it a crazy day?
It was.
It was. So, yeah. So if you had any problems on Friday, don't beat yourself up about it. It was just we had mixed economic reports that did two things. It said hey, the interest rate cuts that we've been expecting, that might not be the case if the job market, is still so robust. Then on the other hand, there's this businesses and the soft landing. So it was investors were really torn, and that's why we swung both ways between, the soft landing being beneficial, the economy side of it being beneficial, but then maybe the interest rate cuts, we've been too optimistic about it, right? It may not happen. So if you watch the CME Fed Watch tool, it actually declined in terms of expectations for March, April, and May. So that threw things into a tizzy there. Okay. Let's go to metals just to see what gold's up to right now. And here's the daily here. So it's been stable in this range as well. And let's look at energy. Here's your crude. I do like the potential of this to climb, but again, you know, it's sort of very syncopated. Like it'll have one really good day and then the next day will be down, right? So just keep that in mind. It's very volatile. And right now it's pulling back a little bit here. And what is the, let's go to our indices here. What is the Dow doing at the moment? It popped up initially and it's been pulling back. So S&P as well, pulling back a little bit after a rally earlier. Russell, yeah, pulling back as well. So we had a little bit more premium that's sort of given itself up, but that could change by tomorrow morning as well. What's the VIX up to here? 14.2, so a little bit lower than where it closed. Anyway, so check things in the morning before you start trading, and you know, good success this week. It's a full week, make the most of it, and then have a good rest on the upcoming long weekend. Okay,
Good luck.
take care, everyone. Yeah. Cheers.